Hey, if you've been watching my last couple videos, you know we've been talking about bullish strategies in the market, but we haven't been talking about buying stock as the strategy. We've been talking about using options to get very bullish on the stock. We've been talking about how to buy deep in the money call options, which is very bullish, and selling deep in the money put options, which is also very bullish. But today I'm going to show you another strategy that's also bullish. It's called a synthetic stock, getting long synthetic stock using both a call option and a put option at the same time. It's got unlimited upside potential, and you could put it on for practically no cost whatsoever. So if you want to learn this new strategy, stick around and let's just jump right into it. All right, everyone, Lowell here from smartoptionseller.com. Okay, what we're talking about today right here, we got our cheat sheet, usually make these in the videos, the Smart Option Seller Guide to Synthetic Long Stock. Now, if you've never heard about this before, options contracts are very versatile. You can make them into almost any kind of position that you like. But in this case, we're going to be talking about how to take options and turn it into the same characteristics as a long stock position. All right, so let's just jump right in, and we're going to go through the list here, and then I'm going to show you the example, looking at the stock charts and then looking at the option chains. Number one, first and foremost, you have to be very bullish on whatever stock you choose. You can choose any stock, but you have to be bullish on it. This strategy only works if the stock goes up. All right, so you understand that right off the bat. Number two, you will be buying a call option and selling a put option, both in the same trade. They're going to be both at the same strike, and they're both going to be for the same expiration date. And we want to choose the nearest right here, number three, we want to choose the nearest at the money strikes. What are the at the money strikes? The at the money strikes are those options that are closely listed to the current price of the stock. So if the stock's at 100, we're talking about the 100 strike call and the 100 strike put. So we want to use the most at the money strikes. And you can choose any time frame you want, any expiration you want. You know, depends on how long you want to hold the stock for. I'm a long-term investor, so typically I go longer on my option trades. 6 months, 1 year, 2 years, but you can do this on a 1 week option, 1 month option. As long as you're bullish on the stock, this strategy will work. Now, you also want to calculate everything when you do with options, you want to know how it compares to the cost of the stock. So whenever you make an option trade, you want to understand what your potential cost basis is on the stock. Now, I said that these trades will give you either, you can do them for zero cost or very low cost, but you still need to figure out how to figure out what the cost basis will be. And I'll show you how to do that. You're going to take whatever debit or credit you get from the trade, and you're going to add it to the call option strike, and that's going to tell you where you're, or you can subtract it from the put strike, but I'll show you how to do it, and it'll show you what your cost basis is. And if you know anything about deltas, each option has its own delta, and deltas range from 0 to 100. Most at-the-money strikes have a roughly 50 delta, or 50%. Deltas are 0 to 100%. So by buying the put call and selling the put, you take their deltas. You don't have to, it doesn't matter whether it's a negative delta or a positive delta. They'll have to equal up to 100. So when you buy a call and sell a put, which are both bullish strategies on their own, you can buy a call and or sell a put on their own. They're both bullish strategies, but today we're going to combine both of those. And when you combine both of those, their deltas will add up to 100, which is what a stock will have. A stock is just a 100 delta, or whatever you want to call it. A stock is a stock. But an option, both the call and the put in this case, their deltas will equal 100. So you know that the options will move as much as the stock does. And I'll show you the option calculator, how that works as well. So a couple things I just want to talk about here. If you're going to do this trade, you have to be approved in your brokerage account to sell naked put options. Okay, this won't work if you can't sell naked put options in your account. You could do a spread, and I'll go into that very quickly at the end. You can sell a put option, and then you can buy another really low, cheap put option against it if you're approved for spreads, option spreads. If you're not approved for option spreads, and if you're not approved for selling naked puts, I'm sorry, this strategy just won't work for you right now, but I still want to show you how to do it. Also, risk management management is key, okay? If you have any position in the market, whether you're long or short, you want to have some kind of risk management. So in this case, it's a long position. Consider it like being long a stock. What's your risk management? What's your stop out plan? Do you have a stop out plan, or are you just going to hold forever? That is up to you, but understand that this is a bullish strategy. If the market and the stock goes down, it will lose money. I want to make sure everybody understands that up front. So have some kind of stop loss, whatever that's based on, the chart where the stock is, or, if you lose a certain percentage of money, you get out. All right. So everyone understand, have some kind of stop loss. And again, it is a bullish play. I'm down here at the bottom. It is a bullish play. You have to be bullish on the stock. And if you want to understand what the synthetic formula is, if you know a little bit about options, or you can do a little research on options, here it is: buying the call plus selling the put equals a long synthetic stock. Okay, now that we got that under control, let's go into the charts, and then we'll look at the option chain, and I'll show you exactly how to do this trade. So let me pull up my charts here. So the first, I'm going to look at a couple different stocks just to show you how their numbers work. We're going to go with Tesla here, just because Tesla has so much activity. And right on Friday, what was it? May 2nd, yesterday. May 2nd, 2025, Tesla closed a little over $287 per share. Now, we have to look at the option chain to see, that at the money, that could be in between the strikes. So in this case, we could either use the 285 strikes or the 290 strikes, and I'll show you how that works. So if you are bullish on Tesla, and this is not a recommendation, and this is not a real trade, I'm just telling you, if you are bullish on Tesla, here is a strategy that you can use. So let's jump into the option chain and see what we can find on Tesla. Let's pull up Tesla here. Okay, and in this situation, so in the market, when the market closed at 4 p.m. Eastern time, Tesla closed at 287 and change. Here's the aftermarket price for Tesla, a little over 288, trades till 8 p.m. Eastern time. But the option prices are based off of that 4 p.m. close. So we're going to look at July 18, 2025 options that expire in 76 days. This is just an example. I'm not choosing this for any reason, just going out a little bit in time. And since Tesla closed somewhere between 287 and 288, that means, as I said, the 285 and the 290 strikes are what we're going to look at. And here's all you need to know. You got your strike price column here, calls on the left, puts on the right, and all we need to do is look at the bid-ask column. The bid-ask column will tell us exactly the value of the options at that time. So let's start with the 290 strike, and we're going to figure out what the cost basis is and how much money it may cost you, or if you can get a credit out of this. All right. So remember, use the same strike, same expiration day. We're going to buy the call and sell the put. So here's how it works. When you buy the call, you're paying for that option. And when you sell the put, you're going to get money for that option. So in this case, you can see both the 290 put is worth about, $32 and, 35-40 cents. And the call is worth roughly $32.30. So this is would be almost a no-cost trade where you have to pay $32.30 per contract. That's $3,230. That's the real dollar amount. So you pay that. At the same time, you're going to get $3,235-ish dollars. So maybe you make $5, or you get a credit of $5, selling the put, buying the call. So let's just consider this is a no-cost trade. You pay $32.30, you receive $32.30, doesn't cost you anything, and now you're long a synthetic stock. And typically what you would do, if there was a debit involved, you would add the debit to the strike price, $290, and that would be your cost basis. So in this case, your cost basis is $290. Since there's no cost here, you don't have anything to add to the 290 strike. If this costs $33.30 and you got $32.30, that would be a $1 credit debit. So you'd have to add $1 to $290. So your cost basis would be $291. In this case, there's no cost. So your cost basis is $290. That's where you would be long Tesla. If you bought the 290 call and sold the 290 put, your cost basis in Tesla, where you'd be long starting out, is $290. Tesla went out at 288. So your cost basis is a little bit higher than where Tesla is right now, but the trade doesn't cost you anything. Okay, I want to make sure everybody understands that. So as long as Tesla goes above $290 in the next 76 days, you will make money. If Tesla stays below $290 for the life of the next 76 days, you will lose money. And it's the same with anyone who's bought the stock at $288. Their cost basis is $288. So if Tesla goes up, they make money. If Tesla goes down, they lose money. Our line in the sand is $290. Now, if we were to use the 285 strike, let's look at that, where we would buy the call and sell the put. Here's how those numbers would work. So the call would cost us, and we always do something right in the middle, in between the bid ask. So if we had to buy this option, we would pay $34.70 per contract. That's $3,470, and we would receive $29.80 per contract. So let me just grab the calculator and I'll show you how that works. So we're going to pay $34.70 and we're going to subtract out $29.80, and that gives us a $4.90 debit. Everyone understand that? We paid more for the call than we received for the put. So it's a $4.90 debit. So we add $4.90 to $285. So that gives us a cost basis of $289.90. $289.90, which is still a little bit higher than where Tesla is now. Maybe, a dime or a nickel higher than if we did it with the 290 strike. So we understand in this case, it costs us $490 to put on this trade. The cost basis is $289.90. Now, I would probably default, if I was doing this trade, I'd probably default to using the 290 strikes because there's no cost involved and our cost basis is still roughly right around 290. The 285 strike, the cost basis is $289.90. So you're only saving, your cost basis is only a dime lower. I'd go with the 290s if I was to do this trade. So let's take a look at another example. Let's go on to Apple here. And I just want to make sure everyone's good with the math and everything. So Apple closed around $205. Let's quickly check the chart here just to see for the regular trading hours. It closed around 205.35. All right, so let's jump back here into the options. Let's use the 205 strike because that's the closest at the money strike. The calls are going to cost us about $12.10 a contract because that's right in between. All right, so $12.10 debit, and we're going to subtract out the 205 puts, $10.20 minus $10.20. That gives us a debit of $1.90 per contract, or $190. This trade will cost you $190. Buy the call, sell the put. Just the total debit between both trades is $190. So you add $1.90 to 205. So your cost basis is $206.90. $206.90 is your cost basis, and the trade costs you $190. Now, the question is, now you're long a synthetic stock. All Apple has to do is get above $206.90 in the next 76 days. If we look at the chart, now remember, you're bullish to begin with. All you need Apple to do is go up to $206.90 and you're breaking even. Anything higher than that is unlimited profit potential. Anything lower than $206.90, you're losing money. Okay, so you have to look at it as if you're just buying the stock right then and there. That's how the options work. But if you were to buy 100 shares of Apple at its current price, it would cost you over $20,000 for 100 shares. In this case, the synthetics all only costing you $190. You're getting over $20,000 reduction in the debit, but you're still getting long the stock. Now, I want to bring up the option calculator so everyone can see how it works to make sure you understand that when the stock goes up, the call option will gain in value and the put option will lose value. That's what you want to happen. Remember, you're long the call option, so you make money when the call option goes up in value. You're short the put option, so you want that put option value to go down. You make money on the call, you make money on the put. All right, so let's look at Apple. Let's bring up Apple here, put it in, and we can't look at both at the same time. We'll have to do one at a time, and we're going to go out to the July expiration date. So this is the bar chart, barchart.com, free options calculator. I just want to make sure everybody understands that. And when you type in the symbol, it puts in the default inputs here, and this is where the theoretical value comes out. And we'll talk about delta in a second, but we're going to look at the strike price. And so let's go back to the option chain just so we see the Apple 205 call costs around, what we say, $12.10. That was going to be our cost. So the option calculator is figuring out $12.12. So we know the prices are right here. And let's look at the put. The put was going to be about, I think we were going to receive $10.20 for it. And right there, $10.15. So we know that the numbers are all working in harmony with each other. So what I want to tell you is, and the delta for each one, I'll go back to the option chain here. As I said, the delta should add up to about 100. The 205 call, and here's the delta column for the calls. Delta has about a 55 delta, and the put has a roughly 45 delta. You add 55 and 45, that equals 100. So both options working together has a full 100 delta, which is going to move in lockstep with the stock, every penny in either direction. So let's go to the option calculator right here. Let's take up Apple up by $10. Okay, we're going to move Apple's price up by $10, and the delta tells us how much the option price should change. Let's change this to call. Let's look at the call first. Okay, so it's starting at $12. If Apple goes up by $10, the call option should go up by about $5.50. So the delta tells you if Apple goes up by $1, the call option will go up by about 50 cents per contract. That's $55. If Apple goes up by $10, this will go up by about $5.50. So what I'm going to do is just change the number here to $215.35, raise it by $10. This thing should be worth about $17 after I change the number. Okay, so $215.35. And it went up by a little over $6. So it went up by about $6. The delta gets bigger as the stock goes up. So you're gaining more delta as the stock price goes up. So we made about $6 here on the call option. Now let's look at the put. Let's change this back to 205.35. So now the call changed back down. So let's look at the put. The put's worth $10.15. It has a delta of about 44%. So this thing should go down about $4.40, giving us a value of maybe $5.60. So this is going to drop down to about $5.60. We take this up by $10, $215.35. And there you go. It dropped by about $4, right? $4 or so. Let's go back just to make sure. 205.35. It's worth $10.15, and it's going to lose let's change this to 215.35, and it lost almost $4, okay? And here the delta's getting smaller as well. So you're going to gain less on the put as the stock goes up, but you're going to gain more on the call option. So it's working out. The call's gaining money, the put's gaining money because it's going down. Together, you're still going to make between both the call going up and the put going down about $10. So you're tracking the stock all the way through. All right. So that's how you do it. That's how the synthetic stock works. Synthetic long, bullish. You buy the call, sell the put, same strike or the closest strikes that you can to being at the money using whatever expiration date you want. Okay. If the stock goes up, the call will gain in value. Those deltas will keep getting bigger. The put option will go down in value. That's what you want, but those deltas will get smaller as well. So you'll gain more money on the call the more it goes up. Now, as I said, on the downside, let's see what happens on the downside. 205.35. Let me show you what happens on the downside. So the put is worth $10.15. If Apple drops by $10, this thing's going to go up, probably close to $5. Because the delta is going to start getting, with the puts, the delta starts to get bigger as the stock drops. So this will probably be worth $15 or so if we take Apple down to $195.35. Okay, so there you go. The put option went up in this case, And the call option is going to go down. Let me just bring up the call option, change this back to 205.35. Get the call. All right, the call's worth $12.12. It's going to drop about $5 as well. So the put went up by about $5. This is going to go down to about $7 or somewhere between $7.50. Let's bring this down to 195.35. So there you go. Drop down in the $7 range. Okay, so that's what happens on the way down. Apple drops $10, you're going to lose $10 between the call and the put as well. All right, so just another way to get involved in a long stock position. If you don't have $20,000 to buy 100 shares of Apple, but you want to get Apple right at its current price, you're not getting any discount on the stock price, but you're getting a huge discount on what you have to pay to enter the trade. So if you don't want to pay $20,000 to buy 100 shares of Apple, you can buy the at-the-money call, sell the at-the-money put, and if the stock goes up like you hope, you're going to make a lot of money. Think of what your returns are. In the Tesla trade, that doesn't cost you any money. If Tesla goes up by $100, you're making, I don't know, what is that, like thousands of percent, because you have no investment. It didn't cost you anything, but yet you're getting all the returns. Percentage returns are going to be astronomical. All right, so I hope this makes sense with everybody. Just another way to get long the market. That's it. That's all I've got for you. I hope it makes sense. I hope it's give you value here. I make these free videos for everybody to try to help everybody out. We all want to be better traders. Let me show you what we have at our website. Let me pull up our website here, smartoptionseller.com. And if you know what we do at smartoptionseller.com, we sell put options. That's our gig. I mean, that is our thing. We sell put options. So if you know nothing about put options, go to our website, smartoptionseller.com, right up here, and you can get our free ebook. See the More tab here? Click on the free ebook and scroll down, and you can put your name and email address in here for a free copy. I'll send you an email back. It'll have a link for the free ebook. We have our video series on selling put options if you want to take a look at that. And here's our services, a couple of newsletters, one-on-one coaching. We got our probability calculator. Take a look. Down in the description below, I'm going to put a link to the two prior videos, the Deep in the Money calls and the selling the Deep in the Money puts. I'll put links for them as well. Also, read further down in the description. I got books and websites and other softwares that you can look at that can help you in your own trading. All right. Give me a thumbs up. Give me a like. Send me an email. Leave a comment, please. I'm trying to make these videos go viral if we can. Want YouTube to start showing these videos to more people. And send me an email if you want. All right. That's all for me today. I hope this makes sense. I'll see everyone in the next one. This is Lowell signing off.